just ensure that your portfolio looks like Nifty and forget about it for the next 10 years, that itself has compounded by 15%. Forget fund manager who has compounded by 27, 28, 29. If you allocate to a fund manager, it's very good. But if you don't even do that, just Nifty itself has. Now, this thing, 1 crore becoming 8 crore, that cannot happen if you keep selling every time it goes up. Because then it has to get time to compound. And if you keep selling, it doesn't create any compounding. Okay? So this is the reason why we communicate this, buy right and sit tight. And a lot of times, we say that, so what should I be buying? I think it is implicit in what I explained to you, that you don't need to buy something which is called tomorrow's XYZ. जो आज का है वो लोगे ना, तो भी काफी है. Because very rarely a miracle comes up. In the real world, the big becomes bigger. And you are in a country, just imagine this, the largest listed company in this country is TCS, which is $80 billion. 5 lakh crores, approximately $80 billion. The largest company in the world, market cap, Apple is 800 billion. So the largest company in our country is 1/10 of the largest company in the world. Okay? So you are in a country which itself is a mid cap. So why are you a small cap actually? Because in a 70 trillion, see the globally the market value is $70 trillion and our market value is $1.6 trillion. Okay? So what are you saying? Our country itself is a small cap. Our largest company in a global scale is a mid cap. So we don't need to identify something, मतलब कल का चमत्कार क्या होगा? You don't even need to do that. If you just buy what is up and running today, that itself can take you, bank deposit से तो आगे ही जाएगा. That much you have to understand. Okay? So this I have already covered. I think this slide being behind was unfair. That's why I kind of covered it first. But investing is foregoing consumption now in order to have the ability to consume more, because you want your standard of living and your wealth to actually go up. So I think I've already covered these things. There's only one thing which I need to explain to you in this, and don't look at the graph and the chart, just look at a couple of numbers. In the long periods of time, in short periods of time, anything can happen. But over 10-15 years, what actually happens is that the share price grows as much as the growth in earnings. This is 2004 to 2014. What it shows, for Nifty, the earnings have grown at 13% compounded. And the value of Nifty has grown at 14% compounded. So a lot of time people ask me, what is the meaning of this buy right, sit tight? What do we actually do? Like somebody even asked Anup that what is your criteria? How do you buy stocks? So there are many things which you can get into technicalities like return on equity and leverage and no leverage and debt and so many things you can do. You discussed about management quality. I was hearing that. But I tell you one simple thing. What does this chart tell me? This chart says that something which is compounding, the earnings are compounding 13%. I am not paid fees to buy Nifty. So my job is to buy companies which will do better than Nifty. So I say that I have a simple rule. In long period, Nifty earning has compounded 13%. So I make a simple rule that I will only buy those companies which have a track record, which have grown 18 to 24% for the last 3 to 5 years. There are 8,000 listed companies. If you make a criteria that I will only buy those companies which earnings are growing 18 to 24% in the last 3 years, वो 8,000 हट जाएगा, सीधा 150 कंपनी आ जाएगा. Okay, it's a fact. Now, if I say that for a company whose earnings are going to double, 18 to 20% means earnings will double in 4 years. So if I say that I will only buy those companies which have the ability to double their earnings in the next 4 years. Okay, keep this in mind. So you understand that कभी ना कभी तो share price भी double होगा if earnings will double. Because when you buy shares, you get dividends from the earnings. So if the earnings are going to double, as per this, what it shows that eventually the shares will also double. Keep that in mind. Then somebody asked, तेजी आएगा, मंदी आएगा, तेल का दाम कहाँ जाएगा, चाइना कहाँ जाएगा? These questions also be asked. So if I tell you that in an environment where there are a lot of headwinds, the share price will double much after the earnings have doubled. And in a teji, the share price will double before the earnings have doubled. This is what happens. Because when there is a teji, without any news, the prices go up. When there is a mandi, despite performance, prices don't move. So if I make a rule that I will only buy those companies whose earnings will grow 18 to 24%, right? So every 4 years, the earnings will double. If the market is bullish, I will get returns in 3 years. If the market is bearish, I will get returns in 6 or 7 years. Does it sound simple? Right? So these are basic things. That's why I said that you don't have to do so much research about what stocks to buy and all. You just buy a simple fund which will invest in good quality companies. You see ask for the portfolio. You tell your advisor to show you the portfolio, and you buy what you understand. And it's not your job to understand actually. When they identify, that is what they would identify. Correct? The problem comes when we try to do something fantastic. So what I have noticed is that आमतौर पे हमारा पैसा डिपॉजिट में पड़ा होता है. जब तेजी आती है ना, तो सीधा छलांग मार के यूनिटेक और सुजलॉन में पहुंच जाता है. बीच में रास्ते में कुछ नहीं आता है. Right? So before you actually jump there are so many things in between. Before you straight away buy that bank which came up from the south, on the way you could have bought State Bank and HDFC Bank also. So what happens जब मंदी होता है तो हमारा पैसा बैंक में है, तेजी आता है तो हम लोग सब एकदम we become all turbocharged. I have to buy the next winner. Okay, so that actually results in problems. So this is the last part that I wanted to share with you. Thank you very much for listening me out. If you have questions, I'm happy to answer. I don't know if we have time for questions.
No, I think we have. It was a wonderful presentation. So definitely we have around 10 minutes time for Q&A. We have first question here. And please raise your hand, we'll bring across the mic to you.
I first of all thank you for extremely enlightening and a very light discourse on very, very important subject. It was very good.
इससे ज़्यादा technical मुझे आता भी नहीं है.
Good. Good. Now, see, you have given, you and Anup, you all talked about so many things about, important things about the stock market and what affects it and all that. What do you think about politics? In my understanding is that this present bull market has started only because of Narendra Modi in 2014.
Yeah.
Now, Narendra Modi, people are also wondering that is he doing his job satisfactorily or not? And people are now getting a little upset and edgy about him.
Yeah.
Okay. So now, if he really, slows down for reasons beyond his control, how do you see the market going?
Okay. So his question was that what is the impact of politics? And obviously the fact that in anticipation of Mr. Modi becoming Prime Minister, the market started going up. Market is holding up, but people are getting a bit worried about whether he's doing his job or not. And I've seen people actually get irritated when they know that he's in Mauritius. क्या कर रहा है यार, काम नहीं कर रहा है. People have those kind of reaction. ये सब जगह घूम रहा है. So I'll tell you my opinion of this. So as a portfolio manager, you should understand politics very well. You should have an understanding of politics. But in reality, we don't invest in anything which has got any impact of politics. So as a rule, normally speaking, I can't say it's like a cast in stone. But generally speaking, we don't invest in companies whose customer is the government. I don't mean to say we will not invest in public sector companies. We invest in public sector companies, but there is a difference. The companies could be private sector or public sector, but generally we are scared or we are a bit cautious of investing in companies whose customer is the government. That is, that is one thing which is our experience. It's not right or wrong. But to answer your question, I personally disagree when you say that the market went up only because of this anticipation. So I'll tell you 2 or 3 things. According to me, the market started going up because few years back everybody thought that the US is going to matlab, basically a few years back people thought that the world will come to an end, but the world didn't come to an end. So actually, see, the situation of US has been something like this. In 2008, and according to me, the market started going up because of revival in US and because the world didn't come to an end. That's when the market started going up. Then, apart from Mr. Modi winning, our economy, जितना बुरा हाल एक साल पहले था, उतना बुरा हाल अभी नहीं है. That is why the market went up. And then there was a surprise election result. So there are various parts to it. Let me first clarify the thing on US. Most people in the last 4 or 5 years being very fashionable to say that US will come to an end. I agree with what Anup said. We are not supposed to bother about it. But just understand one thing, that US is more than 30% of the world's market cap and more than 30% of the world's GDP. So if anybody seriously had a view that US was going to come to an end, then they shouldn't have been investing. Then you can only keep money under your takiya and sleep. You can't invest. Because actually you're talking about the... so what happened was, see, let's put it simplistically. 5-6 years back when there was a crisis, US was obviously in a recession. So what they did was that they brought interest rates down, they flooded liquidity. See, it's like this, when there is a recession, इनको इन पे भरोसा नहीं है, इनको इन पे भरोसा नहीं है, nobody does business, nobody wants to lend to anybody. So the best way to ensure that it revives, sometimes when the car doesn't start with the ignition, you push, you jump start the car. So they, in some sense, they jump started US. How they jump started it was that they reduced interest rates dramatically, they flooded the market with liquidity, and they forced banks that, okay, all your NPAs I will take away, I am giving you money, start again. Meaning reset button दबा दिया, game फिर से start होगा. It's like musical chair, you know, you were left without a chair, but somebody is benevolent, he said, अच्छा फिर से चालू करता है. Okay? So they started again. So as a result of that, the US economy actually started reviving. Now, when US was in a recession and there was huge amount of money being flooded, which assets went up? Which prices went up the most? Oil and gold and commodities. Okay? So when they flooded the market, oil, gold and commodities went up. India does very badly when oil and gold and commodities and goes up. Stock markets generally do very badly. But when this started impacting positively, US economy started growing. So people's confidence in financial markets started coming back. As a result of that, oil, gold and commodity prices started to go down and US equity market started to go up. When US equity market starts going up, that results in greater confidence in the global economy. That results, so Americans are the biggest investors, they start putting money in US equity, automatically there will be a spillover, they will start putting money in global equity. Globally the money in equity started going up. So if you see Mr. Modi's election, he was announced as PM candidate in September 2013. But FIs have put between $15 to $20 billion in our country every year in the last 4 years. They were the only ones who were not waiting for him to be announced as a PM candidate. They have been investing all along. So first reason why our market bottomed September 2013 and it started going up was foreign money and improved global sentiment. Second reason was the election. Third reason is that in reality, you know, in September 2013, rupee was 69 to a dollar. Inflation was very high. Interest rates were very high. The economy was growing at 4.2%. So many things were there. We were supposed to have a hung parliament. We were supposed to have a third front government led by either Didi or Amma or Behenji. So there were so many of these concerns. Right now, none of them are there. That's why the market has actually revived. Now, if you see whether Mr. Modi is doing his job or not, there is no way to know.
Ashish, you have a slide wherein you says 2004 to 2014.
Yeah.
This was complete Congress rule, but
yeah, so,
the market still
so if you see these earnings and so what we do actually, why I told you is that it's good to have knowledge of politics, but it doesn't impact us, is because ultimately we have to buy those companies who are making profits. And we, at least we as a portfolio manager, we don't wait. We will take the decision when the numbers are in front. अभी कोई बोलेगा कि अच्छा मोदी साहब आएंगे तो इसका ऐसा हो जाएगा तो होगा तब देखेंगे ऐसा see it's a when he was supposed to win the election lot of people said that XYZ group का कंपनी लेना चाहिए क्योंकि उसका सब दोस्त है तो all those share prices went up. That's fine, that's a, you know, you made money, there's nothing wrong with that. it's not our forte, so we stay out of it. And if you see these particular 10 years when the earnings have compounded by 13%, in these 10 years we started with BJP government, then we had Congress with left, then we had Congress with Trinamool, and we are back to a BJP government, and we had global financial crisis and 2611, and you had everything. But the earnings of companies have compounded 13%. And Nifty has good companies and bad companies. Still it is compounded 13%. You will pay us a fee only if we buy the good companies. So you are protected basically.
Any question? Yeah.
And the return over 10 years and all, but then the first investment advice you give everybody is that past performance is not indicative of future performance. So then why the...
So I'll tell you, past performance is not indicator of future performance is very, very relevant when you analyze our performance as a portfolio manager. Because what happens is that you need to test a portfolio manager for consistency. See, it may be slightly complicated, but I'll explain something to you. What is the meaning of consistency? Most people here, they understand consistency as consistency of returns. मतलब हर साल 15% आया continuously, people assume that is consistency. In reality, for a fund manager, you know what is consistency? किसकी गवर्नमेंट है, यूएस में क्या हो रहा है, चाइना में क्या हो रहा है, उस सब से हमारा कोई लेना देना नहीं है. We only buy those companies whose earnings are growing 18 to 24%. We don't buy companies which are riddled with debt. We don't buy companies who have huge government interference or political sensitivity. So what happens is, sometimes these companies will give great returns. Sometimes all kind of kachra will be flying up. Okay? Irrespective of what is happening in the market, irrespective of what is happening in US, irrespective of who is our prime minister, I have laid out my philosophy. What is my philosophy? Buy good companies, never sell, just hold on to them. Because what we believe as a company is that wealth is created by buying good companies and holding on to them. So it is important when you say past performance is not indicator of future, it's important for you to understand that when you are judging a fund manager, that is he consistently applying his principles? Because the returns, the numbers may fluctuate, but is he consistently applying his principles or not? You look at it, it's easier explained with cricket, right? There are some times when Virat Kohli scores a century, there are some times he scores 50, there are some times he scores a duck. There are times when he is playing really well. He has faced only 2 deliveries, both of them have gone for a 4, and the third time, because of a mistake of his partner, he is run out. Correct? So, will you say for Virat Kohli that past performance is not indicator of future? Or is that statement more applicable to someone like Mahendra Singh Dhoni? Who will you apply that statement to? See, a guy who has laid out his process and technique, okay? Sometimes the bowler really bowls a good delivery, man, so he got out. But is he a sound batsman? Does he have a technique? See, when Dhoni hits a 6, एक बार मार दिया, फिर पता नहीं अगली बार फिर से लगेगा कि नहीं लगेगा, because there's no process behind it. You know, he's just a whiz kid. He's a genius, but you don't know how he does it. Whereas a Rahul Dravid or a Virat Kohli, you know that if the ball is pitched like this, his front foot will come out, he will lift the bat, give it a straight face, and he will have a proper follow through. कभी ऐसा बैट घुमाया, कभी ऐसा बैट घुमाया नहीं होता है ना. So what happens is that when you are analyzing fund managers, it's good to keep in mind that past performance is not indicator of future. When you are analyzing companies, okay, there also the statement applies, but generally speaking, unless and until a company changes its way of working dramatically, meaning you see Hero Motors, right? For 30 years they are making motorbikes and selling it to people. They're only getting better at it. It's not that suddenly they say, okay, now instead of 2-wheelers, we'll also make 4-wheelers. The day he says, I will start making 4-wheelers, we will actually sit back and think. I mean, you know, why is he doing this? Like Anup said, change of management, right? So unless and until something catastrophic happens, or unless and until the company makes some dramatic mistake, companies don't change their performance or their track record so dramatically suddenly, because they are run by some process and some philosophy and some thought, guidelines. But fund managers, that statement applies very well. Past performance is not indicator of future, because the stock market is not in our control. We keep doing what we are doing, but the stock market is not in my control. What is in my control is what kind of companies I will buy. So there is a difference between the two.
Be it financial planners or investors, laymen like me, always look at PE range for getting in and getting out of the market. How authentic, how advisable it is. Like people tend to say 24, a very high kind of a PE. Stock seems to be very expensive. I mean, then what exactly,
Sure.
how is it?
I think Anup mentioned it briefly, but I'll clarify. I'll clarify this to you. According to me, PE is not the only indicator. Okay? The reason is like this, that first of all, so in any ratio, it's P by E, so there's a numerator and a denominator. And unfortunately, you're always fixated on the numerator. And everybody who comes on CNBC speaks about the numerator. Okay? And then sometimes they quote the ratio itself, P by E, saying that it's high or low. But it is always linked to some movement in the P. Oh, दाम बहुत बढ़ गया है, PE ratio बहुत बढ़ गया है, right? So people are fixated on the numerator. The trick lies in the denominator. We are paid to study the denominator, not the numerator. That is first. Second is, logically as human beings, we are wired to understand the movements in the numerator. But it's a little bit more difficult to understand that when the denominator moves, the impact is opposite. Correct? So what happens is that there are two companies, both at 24 times PE. Okay? One company has not seen growth and is not likely to grow for the next year or two. The other company, last year it grew at 40%, and next year it's likely to grow again at 40%. So the P's are the same, but in one company the E is headed down, the other company the E is headed up. Second thing, the price remains the same, but the earnings are on a decline. So automatically the PE will shoot up, correct? The price remains the same, but the earnings are growing fast. Without anything, the PE will start coming down. So what happens is that, like, if you see last 5-6 years, one of the most expensive stocks is Eicher Motors, correct? Now what has happened is that, and in our market it has been happening in the last 3-4 years, I don't know how many of you have noticed, the expensive things are becoming more and more expensive. Meaning there are few stocks which are just becoming more, like Eicher is there, Page is there, somebody mentioned Bosch. So there are some stocks which are becoming more and more expensive, as if everybody wants to buy these stocks, right? But what happens is that, it's just that in the full market, everybody has, lots of people bought lots of things thinking that Mr. Modi has become PM, so I don't know what is going to happen. But actually very selective companies are able to grow their earnings. Like irrespective of what is happening in US or what is happening to our politics, Royal Enfield is selling more and more bikes. So it has nothing to do with what is happening in the rest of market. His sales are growing at 40-50%. His margin is 20%. His earnings growth is like this year over last year, their profit growth is 61%. Okay? So in a market where only few companies are performing very well, all these P's and all, they get exaggerated. So you have to focus on the denominator. That is the whole issue. So anyway, let me just tell you very clearly, whatever I'm saying are all examples. It has nothing to do with our portfolio. I'm telling you purely as examples, just to educate you on certain things. It's not a recommendation.
Thank you so much, Ashish. I think one thing we have understood from this session and last session was that money is always made by sitting and not selling. You know, you can only create wealth by sitting on it. And secondly, as he rightly mentioned, buy right and sit tight. Right? On this note, I think can we have a wonderful round of applause for Ashish, the man from Motilal Oswal.
Thank you.
I think it has been a fantastic evening. So we would just now like to close this by word of thanks. First of all, I would like to thank our partners. आपने इतना अच्छा ज्ञान दिया, so I think we should reciprocate that. So can I invite Saurav Mittal to please come and hand token of appreciation to Ashish the books. First of all, we would like to thank our two partners of the event, Motilal Oswal and DSP BlackRock Investment Managers, for supporting us. Without their support, this certainly would not have been possible. And secondly, to all of you, Anup mentioned Saturday evening, I think the house is almost full, 200 investors, what you're doing here. I hope your evening was worth coming all the way to here, and you had a wonderful lessons in investments and knowledge. So we'll meet next year. So now we leave open for dinner and bar. The soup